Welcome to a new topic on free cash flow valuation. A key part of this topic is in the various approaches to calculate free cash flow, which we'll expound in this lesson. We'll start with a basic definition of free cash flow, followed by the computation of FCFF and computation of FCFE. Let's get rolling. One key complaint by candidates is the large number of formulas to remember for the calculation of free cash flow. We shall attempt to make the process simpler for you, that you only need to remember a couple of key relationships and derive formulas the rest from there. Let's start with the basics, which you must remember. Let's forget for a while all about financial reporting, which accounts for several non-cash elements like depreciation and accruals, and just view the company in terms of the cash inflows and outflows. When the company makes a sale, cash flows in. There are cash operating expenses like salaries and rent, but this should not include interest expense as it is a financing cash flow. We'll explain more on this later. Part of the income is taxed, so cash taxes leave the company. The leftover cash is used to make short-term net investments in working capital and long-term investments in PP&E, which we call fixed capital investments. The remaining cash is called free cash flow to the firm because it's free to pay out to the firm's investors, that is both debt holders and shareholders. The formal definition of FCFF is the cash available to all of the firm's investors after the firm buys and sells products, provides services, pays its cash operating expenses, and makes short and long-term investments. What does the firm do with its FCFF? First, it pays the bondholders their rightful interest as these are obligations. The net cash that leaves the company for interest payment is reduced by the marginal tax rate, as interest payments in many jurisdictions are tax deductible. The amount that is left is called free cash flow to equity, or FCFE. However, the firm may also pay back the principal of some of its debt or borrow more money from bondholders. We call this net borrowing. As you can see, the FCFE is the FCFF after debt financing, so the amount is only available to shareholders. Notice the word used is available and not paid out. Typically, not all of the FCFE is paid out to shareholders as dividend, as the management may want to conserve some cash for future periods. And there we have it. These are the basic definitions of FCFF and FCFE, which you have to remember. However, not many companies calculate and report their free cash flows for each period. Your job as an analyst is to infer the free cash flow from their financial reports. There are several approaches to do this, and unfortunately, you're required to know them all. The good news is, we'll teach you a methodical way to visualize and remember the relationships. The income statement starts with the revenue, which is the main source of cash input for most companies. The first thing you need to do is to establish the various profit measures, that is, how the EBITDA, EBIT, and net income progress from company sales. We know that EBITDA is after operating expenses, but before depreciation and amortization, so this amount of operating expenses is approximately the same as the cash expenses. EBIT is after depreciation and amortization, which is for the bulk of non-cash charges. Net income is EBIT after interest and taxes. Suppose we wish to calculate the FCFF from EBITDA. We know that EBITDA is after cash operating expenses but before taxes, so we start here such that we can cancel out cash operating expenses. First, we need to take care of taxes, which can be accounted by multiplying EBITDA by 1 minus the tax rate. However, as EBITDA is before depreciation, we should add back the depreciation tax shield. Minus working capital and fixed capital investments, we get FCFF. This is how we derive FCFF from EBITDA. Now, let's try to calculate FCFF from EBIT. Likewise, EBIT is before taxes, so we start from here. As with EBITDA, we should deduct taxes, so this term handles that. However, since EBIT is after depreciation, which is a non-cash expense, we should add it back. And likewise, account for working capital investments and fixed capital investments, we get FCFF. By now, you should know how this goes, so why don't you try to derive the formula for FCFF from the net income before we reveal it? Net income is after taxes, so we should start from here, such that we can cancel out taxes from our equation. We can see that net income is after non-cash charges, so we add them back to calculate cash flow. Likewise, interest expense should also be added back, as they are cash that is available to debt holders. As interest expense in most jurisdictions is tax deductible, the net cash interest paid is actually reduced at the marginal tax rate. Again, we subtract working capital investments and fixed capital investments. This gives us the FCFF for the period. If there is one formula that you want to remember without taking time to derive, it is this one, as it is the most frequently tested. Now, sometimes you may be asked to calculate free cash flow from CFO. Broadly, CFO is net income, add back all the non-cash charges, minus working capital investments. You can probably see where this is heading. CFO will fit right here, so that we can cancel out working capital investments. As such, the only adjustment needed is to add back interest expense, which again has to be adjusted for taxes. So FCFF from CFO is simply the CFO plus interest expense minus fixed capital investments. And these are the four key equations for calculating the FCFF based on EBITDA, EBIT, net income, and CFO. Deriving the corresponding FCFE equations is simple, as we can follow through from FCFF. Subtract the interest expense as these go to the debt holders, plus the net borrowing from the debt holders, which is defined as all new debt issuance minus all debt repayments for the period. If you notice, the interest expense can cancel out, further simplifying some expressions. As such, these are your equations for FCFE. As you can see, you don't have to memorize all 8 formulas. Rather, remember these 2 lines and you can derive the appropriate equation for calculating free cash flow. After deriving the appropriate equation, the next step is to calculate some of the items that are not so readily inferred from the financial statements, which are working capital investments, fixed capital investments, and non-cash charges. Let's go through each of them. The first is working capital investments, which is the change in working capital for the period. In most cases, working capital refers to current assets minus current liabilities. However, for the purpose of calculating free cash flow, you should exclude cash and cash equivalents and short-term debt such as notes payable. Another way of looking at this is that working capital investments is the increase in inventory plus the increase in accounts receivables minus the increase in accounts payables. Fixed capital investments require a little more explanation. Essentially, this refers to investments in long-term fixed assets, known as capital expenditures, which is simply calculated as the change in net PP&E plus depreciation. A more precise figure to use is to look for an item named Purchase of Fixed Assets under CFI in the cash flow statement. However, if there were sales of fixed assets during the year, the sales proceeds should be used to offset the capital expenditures in determining fixed capital investments. Look for an item named Proceeds from Disposal of Fixed Assets under CFI in the cash flow statement. And lastly, non-cash charges. Primarily, this refers to depreciation expense, which we know should be added back to calculate cash flow. You often see some literature using non-cash charges and depreciation interchangeably. However, there are other non-cash charges that you may want to make adjustments for. This includes amortization expense and impairment charges for intangible assets, which, like depreciation, should be added back to net income for free cash flow calculations. Provisions for restructuring charges are also non-cash expenses that should be added back to net income. However, if the firm is accruing these costs to cover future cash outflows, then the forecast of future free cash flow should be reduced accordingly. Conversely, income from restructuring charge reversal is a non-cash gain, so it should be subtracted from net income. Unrealized losses that are recorded on the income statement should be added back, while unrealized gains are subtracted as these do not affect cash flow. For outstanding bonds in the balance sheet, amortization of bond discount should be added back to net income, while the amortization of bond premium should be subtracted from net income. Increases in deferred tax liabilities should be added back to net income, while increases in deferred tax assets should be subtracted from net income in the computation of free cash flow. However, both of these should be conditional that the liability or asset is not likely to be reversed in the future. Otherwise, do not adjust for changes in deferred taxes. In essence, non-cash expenses are to be added back to net income, while non-cash income are to be subtracted to arrive at free cash flow. And here's the moment to apply the formulas to calculate free cash flow. Given the following income statement and balance sheet of a company, compute its FCFF and FCFE for the 2016 financial year. Pause the video now and work out your answer. You may want to use the formula based on net income as a guide. And we're back. Let's start with calculating working capital investment. We learned earlier that working capital is current assets minus current liabilities, excluding cash and cash equivalents and short-term debt. For this example, the working capital investment is the increase in inventory plus the increase in accounts receivable minus the increase in payables. Plug in the figures, we get $7 million. Next, fixed capital investments. Since we're told there was no sale of long-term assets, The fixed capital investment is therefore just the capital expenditure, which is the change in net PP&E plus depreciation. Plug in the figures, we get another $7 million. With these two in the bag, we can now calculate the FCFF using our formula. Net income is $26 million, and non-cash charges is only the depreciation expense of $4 million. Interest expense of $5 million is reduced by the tax rate of 30% and deduct $14 million for investments. This gives us an FCFF of $18.7 million. And lastly, let's calculate the FCFE, which we can follow through from FCFF. Net borrowing is the increase in short-term and long-term debt for the period. Plug all the figures in, and we get FCFE of $14.2 million. And that concludes this lesson on the computation of free cash flow. Do be clear on the basic definitions of FCFF and FCFE and the progression from EBITDA, EBIT to net income and on to CFO. With that, you should be able to derive any formula to solve for FCFF or FCFE based on the information given to you in the exam. In our next lesson, we shall learn the perspective and situations where free cash flow valuation is appropriate.